You're listening to the Eastline Brief, providing an economic perspective on Central and Eastern Europe.
Need reliable company information anywhere in the world? With company reports worldwide from InfoBroker World, you get verified business information, registered data, and financial insights about companies in over 100 countries. Perfect for due diligence, supplier checks, and international business decisions. No membership required. Order your company report online today and gain the information advantage for your business.
Hello and welcome. My name is Elena Novak. I am an information influencer for InfoBroker World based in Prague, and I focus on economic developments across Central and Eastern Europe. Today, we are looking at Hungary in 2026, a year that stands at the intersection of economic pressure and political transformation. From Prague's perspective, this shift is significant for the entire region because Hungary is deeply integrated into European industrial value chains, especially in automotive and manufacturing. Let's look at the numbers behind this trend. Hungary enters 2026 after several years of economic stagnation. Growth in 2025 was extremely weak, around 0.3%, reflecting a prolonged slowdown in industrial output and external demand. The Hungarian National Bank recently adjusted its growth forecast for 2026 down to approximately 1.7%, while other institutions, including the European Commission and private banks, expect a slightly higher range between 2 and 3%. This suggests recovery, but without strong momentum. Inflation, which peaked at over 25% after the outbreak of the war in Ukraine, has eased significantly and is now around 4 to 5%. However, the price level remains elevated and real wage recovery has been gradual. At the same time, Hungary's fiscal position remains strained, with a budget deficit still hovering around 4.5 to 5% of GDP. This creates pressure on public finances and limits policy flexibility. Another critical factor is the forint, which has shown volatility in recent years. Combined with rating agency concerns about fiscal stability, this increases borrowing costs and adds another layer of uncertainty for investors. Now, if we move from the macroeconomic picture to structural challenges, the dependency on industrial exports becomes very clear. Hungary's economy is highly exposed to the automotive sector, which accounts for roughly 30% of industrial output and about 20% of exports. Yet this very strength has turned into a vulnerability. Weak demand from Germany, Hungary's key trading partner, has significantly affected production. In 2024, car production dropped by around 14% in volume terms, and battery exports declined by nearly 25%. At the same time, EU funds, a crucial investment driver, have been partially frozen over rule of law concerns. Estimates suggest that between 17 and 22 billion euros have been unavailable. This has had a tangible impact on infrastructure development, business investment, and overall economic confidence. And this brings us to a defining moment: the parliamentary election of April 2026. Hungary experienced a political shift of historic scale. After 16 years in power, the previous government was replaced by the TISA party under Péter Magyar, who secured a strong parliamentary majority. For the economy, this is less about politics and more about expectations and credibility. The most immediate economic channel is the relationship with the European Union. A more cooperative stance towards Brussels could unlock the frozen EU funds. If even part of the estimated 17 to 18 billion euros is released, it would significantly stimulate investment in infrastructure, energy systems, and industrial capacity. Financial markets have already reacted. The forint showed signs of stabilization, and equity markets responded positively, early indicators of regained investor confidence. But let's stay grounded in the data. A political shift does not automatically translate into economic recovery. The new government faces a difficult starting position. Public finances need consolidation, and this often requires unpopular measures, spending cuts, tax adjustments, or structural reforms. At the same time, expectations are high. Businesses are looking for regulatory stability, fewer ad hoc interventions, and a predictable policy environment. If reforms in areas such as judicial independence, anti-corruption measures, and institutional transparency are implemented credibly, Hungary could reposition itself as a more attractive investment destination within the EU. If not, confidence could erode again quickly. Let's also look at one of Hungary's key sectors, the automotive industry. Despite current weaknesses, Hungary remains a major production hub in Europe. Global players like Mercedes-Benz, Audi, Suzuki, and BMW continue to invest. BMW, for example, is preparing production in Debrecen, while Mercedes is expanding its footprint in Kecskemét. At the same time, Chinese manufacturer BYD is building a major electric vehicle plant in Szeged, although mass production has been delayed and is expected to ramp up gradually from 2026. This reflects a broader trend. Central Europe's strength lies in transformation, but transformation takes time. The shift toward electric mobility, combined with global competition and cost pressures, is reshaping the industry. Hungary benefits from established supply chains and relatively competitive labor costs, but it also faces increasing competition from locations such as Turkey. So what does all this mean for Hungary in 2026? We are not looking at a crisis year in the classical sense, but we are also far from a robust growth phase. This is a transition year, shaped by structural weaknesses, but also by a window of opportunity. The key variables are clear. First, fiscal discipline. Can the government stabilize public finances without undermining growth? Second, EU relations. How quickly and to what extent will funding be restored? And third, investor confidence. Will Hungary provide a stable and predictable environment for long-term capital? If these elements align, 2026 could mark the beginning of a moderate but meaningful recovery. If progress is slow, the economy may remain stuck in a low-growth environment with persistent vulnerabilities. From a regional perspective, this matters beyond Hungary. Supply chains, investment flows, and industrial strategies across Central Europe are interconnected. A stabilizing Hungary supports regional resilience. A stagnating Hungary creates friction. Data builds bridges. It connects markets and people. And in Hungary's case, 2026 is a year where data, politics, and economic reality intersect in a very visible way. Thank you for listening.
Reach decision makers around the world, advertise on the Info Broker World podcast, and connect with a global audience of entrepreneurs, executives, and business professionals. Share your message where business insights matter. Info Broker World podcast, your gateway to international business listeners. Learn more at infobrokerworld.com or contact us.
Thank you for listening to the Eastline Brief. You'll find more details, data links, and background information in the show notes below. I'm Elena Novak, your virtual information influencer from Prague. I'm an AI-generated voice and digital analyst designed to share clear, data-based insights about Central and Eastern Europe. My goal is simple: to make complex economies understandable and to build trust through knowledge. And if you're interested in creating a podcast like this for your own platform or organization, I'd be happy to connect and explore the idea with you. Until next time, stay curious and stay connected.